Okay, so thank you for coming. Today's topic is improving trading performance through understanding of causation and correlation. So this is very important topic in my opinion, and you can give me the feedback at the end of the this session. You can send me an email at coaching@tradegenie.com or success@tradegenie.com and let me know if you learned something. And I will upload this on my YouTube channel called The Real Trade Genie. So there are many other sessions like this on the Real Trade Genie channel. So this will be a long session, at least 1.5 hours. I have not taught most of it before, so this is the first time I'm teaching. So bear with me. There are about 77 slides. So this slide we all have seen before. About I talk about the comfort zone, and when we get out of the comfort zone, we break through and we go to the edge, and that's where the results come in. So we go beyond our limitations and beyond of our thinking that what is possible to achieve. So it's there, is there, it's beyond our comfort zone. So it's beyond our comfort zone, everything lies there. So 9 to 5, mediocre life. Even if I have I don't for me, even if I work, it depends. So even if I work as an executive somewhere and I'm just going there 9 to 5 or working executive, that's not what I believe that I'm successful. Is something inside. So something inside what I'm trying to achieve and what you are trying to achieve. That's why you are here. And most of you are regular to my session. So beyond comfort zone is the breakthrough. So now this slide I've shown you before. So it's all, this presentation is all about how to achieve the breakthrough success. So I will explain to you how the top traders think and how they operate in the market. That's what I understand, and I'm trying to understand how they operate in the market. So this pie chart shows that on the only the 11.5% traders are successful, and 18.5% are break-even traders. So 18.5% in 3 years of result, which is not bad. 18.5% of the traders are break-even traders. 11.5% are the successful traders, and only 1% of all these traders are the top traders, and the rest of the 70% traders lose money in the market. So the money the 11.5% are making from these 70% of the traders. So there must be something 11.5% traders doing, which the 70% of the traders are not doing. So think about that. But the 70% of the traders are not doing what 11.5% traders are doing. So we need to know what they are doing and what we are doing. So that's the problem, right? Are you seeing my screen? I'm moving my screen, so I hope you see my screen. Yeah, okay. So now there's something called opening the loop and closing the loop. So I I am there people, the different kind of personality in this world. The God has created different kind of personality. Some people prefer open loop. They don't care. They start a conversation. They don't close that conversation. They start a project. They don't close that project. Some people, they like to start the project. Some like to close the project, some like to come in between the project. So think about it, what kind of a person you are. So do you take your project from start to finish, or you just jump in the middle and don't worry about what happened before and what will happen at the end? Or you are the person who wants to start the project and close the project? So I'm the kind of person, what I think I should be is I start something and I close that something. So start the loop, close the loop. So that's what it is. So starting the loop, how you start the loop in with respect to trading. So starting the loop with respect to trading is in early morning. First of all, wake up early morning, like 1 hour, 1.5 hour early, fresh, 4 o'clock. There's no alarm clock. The birds are chirping, your window open or your balcony doors open, and fresh air comes in, and you naturally wake up looking forward to the day. So then you do the shower, coffee, meditation, mental rehearsal, get ready for the market, and then you start your day. And then during the day, you're trading, whatever you're doing, you're trading. And then at the end of the day, or near the end of the day, you close the loop. So how do you close the loop? You take notes, whether you take the notes of your trading through informal way or formal way. So I will explain to you what is informal and formal. So I have a diary. I have an online diary, and because I'm doing a lot of trading, so I have a assistant also. So I go through with him all day long and journaling our thing called debriefing. And before the end of the day, we do the debriefing of all the trades we took, all the trades we closed, all the trades we missed, all the mistakes we did, etc. And all the exits which could have been taken early, could have been taken delayed, could have taken partial, etc. All that is documented and being discussed. So why we do that, why I do that, and why I'm telling you to do that, because it's essential for consistent top performance. If you don't, when you come home, you need to, even beyond your trading, whatever you're doing, when you come home or when you are driving home from your work, you need to think about what happened during the day. So it's so that you can wrap up the thing, you close the loop, is an essential for consistent top performance. So you learn. So if we don't learn, we don't improve. If we don't eliminate our mistake, we don't improve. So it's crucial practice for traders. Very important that they do the daily debriefing and reflect whole day of their trading activities from start to finish. What happened? Visualize all the important points in the day, the time when you acted and how you acted, what you looked at, how you took all the decisions. So, and then identify the areas of improvement. There is always something during at the end of the day. I'm not saying we need to, I'm a perfectionist. I am by being Virgo, but it's not analysis paralysis, something like that. But it still needs to find some areas for improvement. Otherwise, what's the point of like living? Why I'm even alive? It's not just trading, but other areas of life for improvement, like self-improvement or physical improvement or mental improvement. Or do something, do some community work. So same way, identify areas for improvement. So at the end of the day, when you're doing debriefing, then the question, there should be a journal called aha journal or aha moment, where you say, aha, that's what I saw, and that was the trade of the day, and I need to remind myself next day, tomorrow, and you get excited that I should be looking for the same kind of chart pattern or same kind of activity what I saw in that trade. So it will help traders learn from their experiences. So you're building you're creating your trading diary. So you can take this daily debriefing document. So 5 times a week, you're doing 5 times in a week, and there are 250 days in a year. So imagine if you do that formally, create a document, 250 days of your notes. So at the end of the year, you go through that 250 days of your daily debriefing, which you put it as an input to your periodic review. So periodic review, you can define your periodic review quarterly, 6 monthly, yearly. The time is coming for your periodic review, your yearly review, which is now Thanksgiving holidays. You need to take time out, or during your winter break, you need to take time out and do the periodic review. So when you're doing the periodic review, which could be annual review, this daily debriefing document is an input to that document. And then you can make some necessary adjustments. So let's say you're doing your daily debriefing on a daily basis. Then at the end of during the weekend, like on Saturday. So on Saturday, I put all my stuff, important things, which I cannot focus during the trading hours. I put it in a different bucket for Saturday. So I have a noting mechanism. I note with my team that this thing goes in the Saturday, this thing, and then we make a list of the things which I need to do and my own personal things. So this way, I'm continuously enhancing my trading skills. And daily debriefing is also important transition period during trading and non-trading hours. So during the, if you can keep your notepad open somewhere during your in your computers, on your computer, I hope you have multiple computers and multiple monitors, not just a little phone with the Robinhood app, and you're trading from your Robinhood app. So don't do that unless you're just rigidly following newsletter like my newsletter, which I send you, and then you just open and trade close, and you're doing other things. So remember, there is a limitation to that kind of trading compared to you trading on your own. Even you're following someone, but you're sitting at home or sitting in your office and have the luxury of multiple monitors and multiple computers. So think about that. So important transition period during trading and non-trading hours. So a lot of stuff, the bullets are flying. This is what I learned a long time ago when I was learning options. So the coach, the online coach, he said things looks hazy when bullets are flying. Things are looking hazy. So during the trading hour, a lot of bullets are flying, and you're catching a lot of bullets and you're avoiding a lot of bullets. But when the market is closed, then you take a break and do the daily debriefing. So through daily debriefing, traders correct their mistakes. So this is what it is about. It's about efficiency. I will teach you about efficiency later in some other presentation. So these traders, the 11.5% of the traders, they are operating at 90% and above efficiency level, meaning out of 100 trades, they're only making mistake in 10 trades, out of 100. These traders who are operating at 18, and they are break-even traders, 18 and a half, they are operating at 85% efficiency level. That's why they turn into a break-even trader. Out of 100 trades, in 15 trades, they made some kind of a mistakes, not the technical mistake. I'm not talking about the technical mistake or you fail to read the chart. There are some other things, the way they operate, the way they executed the trade, and all the other little bit of mistake here, there, quick exit and late exit, and instead of buying one contract, buying 10, instead of buying call, buying put, there's that, all that kind of thing, not focusing, all that kind of thing lead to the break-even trade. So they operated, even though they were operating quite good at 85% efficiency level. So what happened? Just 5% difference made the difference. They came out to be break even, and others 11.5%. Now the failed traders, they are operating at 85 below 85% efficiency level, meaning they are making a lot of mistakes in their trading. So the lesson is this, that we need to correct our mistakes in trading. We need to correct our mistakes. So how we correct our mistake if we don't sit down and figure out what mistakes we made? So everything requires daily debriefing. So just now in my where my kids go to school, we have the parent teacher organization and movie night and all that. It was very successful, but even then everything went very smoothly, excellent. Had a meeting this afternoon and went through the debriefing, that what went wrong, what went right, how we can improve next time, and near misses, etc. So things are documented. So that's what you need to do in trading. So now the question is the two types of debriefing. So what are the two kinds of debriefing? One is called formal daily debriefing, and another one is an informal daily debriefing. So it's up to you what kind of a daily debriefing you like. So if you don't have time, you can do informal. But if you are the kind of person who is structured and thorough and meticulous, and want to take read your notes and believe in improving, and need some kind of a data at the end of a quarter or 6 monthly or yearly, then you need to do some formal daily debriefing, and it takes like 10-15 minutes. And you can do the daily debriefing, formal daily debriefing, even as the market is moving. When you find the time, like a break, or like when about market is about to close, you can start doing the daily debriefing. Put something in your journal. So goal is to enhance trading skills, remove trading mistakes, and achieve better results. So that's what the purpose is. So now how you do the formal daily debriefing. So formal daily debriefing is a structured approach. So maybe you create a format where you fill in the blanks. So you create a document So today is October 22nd, 2023. You have few lines, you write down the subheading, and you just fill it in. So it's a structured approach. Every time you go through that approach. So for each trade, you take some notes and write it down. Record keeping. So you need to have a open date journal. So there are a lot of journals, trade journal, trading diary. Your what if you develop some edge, your mistake journal, everything is recorded. Your trade analysis, maybe you take the screenshot of that the chart when you took the trade, draw the arrow. When you exited a trade, draw the arrow, and then how the trade moved in its journey. So do that. Have some kind of a performance metrics. Maybe the win rate, the percentage win, the percentage loss, how many trades you won, how many trades you lost, what is the winning streak, what is the losing streak, all that. Another thing you need to maybe do the daily doing psychological evaluation. So psychological evaluation, the what thoughts and emotions went through when you were trading. So maybe you have a journal of your emotions. So if you Google the word emotions or trading emotions, you may find the list of like 250 words or 200 words or 150, whatever words you get. Google, you download those emotions, and then maybe you do the analysis and say, okay, I go through these emotions. So what are the emotions which are coming to you on a regular basis? So maybe from beginning to end, when you're doing the daily debriefing, you write down your emotion, the word, just one word, fear, greed, excited, remorse, regret, whatever is your emotions out of that database. So you put that every day for each trade. So what I see, I document it. And if I document it on a multiple time interval, if I'm seeing something building on a 5 minute chart, I write it down immediately. I write it down in my worksheet. This is what I saw in my 5 minute chart, because the trade is developing from 5 minute to 30 minute, maybe 60 minutes, then 2 hours, then 4 hours, then daily. So the trade is building up, and it starts maybe from the tick chart, or maybe starts from the 5 minute chart. So if something is coming up on a 5 minute chart, then I'm waiting to look at that development on a 30 minute chart, then something coming up on a 60 minute chart. Maybe I'm seeing something on a 30 minute chart, but something else on an hourly chart. So I'm documenting everything. Maybe I saw something today, and tomorrow I saw something else. So because I'm building the history, so I write it down, on a daily debriefing. Today I saw like XYZ symbol. I saw this, I took the trade, and then tomorrow, and what interval I saw, what else was happening. Then for tomorrow, when the same symbol is there, and I see something worth noting, I note it down. So there's a history of the trade for the same symbol. So, and then the risk management. So how did I increase my exposure to that trade, or how did I decrease the exposure of my trade? Where did I put the stop loss? How did I analyze the targets? How did I analyze the support and resistance? So all that is aligned with my goal. So daily debriefing is that important. Now the informal daily debriefing, you can do informal, you can do casual, less structured, nothing written. There's no fixed routine or checklist. Is you can pick up the phone, or you are on the Skype with with your trading buddy, and you just discuss it. Have some self-reflection and go, discuss that. Oh, I saw that Tesla, or I saw Nvidia or AMD. This is, there's not no documentation. All is in your head, and then that's it. And then you talk about the psychological, that if any emotions you ran through, frustration or anything, overconfidence, and that's it. You hang up the call, or you're doing it with yourself. So you're doing it with yourself. Maybe you're driving and you're doing through. You don't have time. I understand you don't have time to do the structured way, the formal way. Maybe at least you go through, visualize the trade, and do this informal daily debriefing. So what is the main purpose? Main purpose is whether you made a mistake during the day. What you saw when you saw that trade, when you saw that trade, something happened to you. whether you saw it or you felt it. So there was some feeling inside your tummy, inside your body, that you saw that trade and you took it, and maybe you saw something visually. So, but you made a mistake, and maybe you made a mistake. So when you made a mistake, even though you made money, but you made a mistake, and you know that you made a mistake in that trade, and even making a mistake, you came out to be the profitable trader. So ask yourself, did you make a mistake? And if you did, then you write it down. So trading mistakes means not following your plan of action. You did not follow your actions, you did not follow the rules, and still you made money. So if we do the daily debriefing, our mistakes will come out. Now, the process of daily debriefing. So the process of daily debriefing is that you sit down, if you are doing the formally structured way, you sit down and you say, okay, I identify and list my trading mistakes for today in the mistake journal. So there has to be a mistake journal. So this is separate from your trading journal, your trading diary, your edge journal, your emotion journal, your thoughts journal. All this is separate. This is another one, the mistake journal. So you can make it as sophisticated as you want. Do some coding. 001 is this. I assign this code to this mistake. 002, I assign this code to this kind of mistake. So when you're listing down your trading mistakes, you assign that code so you can sort it and you can see how many times that mistake came. And then when you identify the mistake, you go back in time. You go back in time, like today at 7 o'clock Pacific, I made that mistake. So you visualize the trade. You visualize the trade, and when you took an action, what you felt, then you ask yourself that when I took that trade, I saw that, and what did I feel? So you must have felt something, or you must have heard something, or you must have seen something. So either you visual kind of person, or auditory person, or kinesthetic person. You, it's what kind of a person you are. How do you take action? So you must have seen something. You must have heard something. You must have felt something. So write it down that I saw that, and what the time frame and what was happening. So what pattern there was, what kind of a volume was there, what kind of a news was there, what else you saw, and what kind of a mental state you had at that time. So recording your mental state is also important. So write it down in your trading journal, or in your daily briefing document, that this was the mental state I had. So for example, the mental state could be that you were bold. So ask yourself, were you bold and courageous when you took that push that buy button, or you were doubtful, or you were timid, lame, and you just happened to push the button, just okay, I go for it, and you were not confident. So ask yourself, what kind of a feeling you had, what kind of mental state you had. And then, because you're recording your mistake and you're visualizing the trade, so when you reach that point where you made the decision, at that point, when you made that decision, you had multiple choices available. So if you go back to look at it, you may have multiple options at that time. So what were those multiple options? It's like in the horror movie, they show the cornfield, and you go straight, the guy goes straight, and then turn right, turn left, and go straight, and then he turns right, and then he gets killed by the bad guy. So that kind of option, you had the option to go straight or turn left, but you turn right. So remind yourself that you had those options available. So what those options? So maybe list down one, two, three options. Make sure that you have a solid options at that time. When you were making a mistake, you had the option. One of the option was not to take not to take the trade. That could have been one option. Then not to take the trade. Who told you to take the trade? One option could have been you could have waited. You forgot to look at the clock. And the market opened for just for 25 minutes, so it was 6:55 a.m. Pacific, and 7 o'clock the market comes out with some news. So you could have waited, but you were impatient. Then you took the trade at 6:55 a.m. Maybe you did not look at the resistance level, or you knew that the stock is facing the resistance, but you were in a hurry because you thought that if you buy 10 minutes or 15 minutes early, you thought that, okay, this market will break the resistance. I'm so confident that I don't mind, I take the trade. So you made that mistake. Now when you were remembering, visualizing, then you started to talk like could have, would have, should have. So don't do that. So just remind yourself that not to do that again. Do some positive self-talk. So don't beat yourself, rather do the self-talk, positive self-talk, and visualize those multiple options. What are they? And mentally rehearse. So now the important part is mentally rehearse executing those multiple options in the future when you encounter similar situation. So mentally rehearse, close your eyes, go back to the trade, see that trade, and then you say, okay, next time when I see that trade, the same kind of chart, what was happening, and I made that mistake, I wouldn't do that. So resolve not to commit the same mistake again. So if you keep doing it every day in a formal way, taking the charts, spending some time, your mistake will go away. When the mistake go away, you will gradually have a positive result. So now anything we do, anything we are doing in life is based on our beliefs. So if you believe in daily debriefing, if you believe that through trading you can create the wealth, then the thing, you will do something about it. So daily debriefing is necessary to correct mistakes and prevent future ones. So that's, if you need to adopt this belief. A mistake is not following your rules, and if you have no rules, then everything you do is a mistake. So definition of mistake is that I don't follow my rules. Then if I do, everything I do is a mistake if I don't follow the rules. Daily debriefing only takes few minutes. So remind yourself, okay, daily debriefing only takes few minutes, and it's one of the most important thing you can do for yourself. So it's like, if I want to um, keep my body fit, I need to go do the, let's say, Peloton 20 minutes, or stretching 10 minutes, or cardio of 20 minutes, or whatever it is. And if I do only once a week, it's not going to work. I need to remind myself, I need to do it every day. It doesn't matter, 20 minutes here, 10 minutes there. I need to do it. Making a mistake has nothing to do with whether you traded successfully. It has to do with not following your rule. So sometimes we make a big mistake, and then even then we come out to be the winner. So still the mistake was there. So recognize that you were saved. And if you're doing the same mistake again and again 3 times or more, then it's self-sabotage. So our brain is wired to self-sabotage. So we need to remind ourselves that our brain is wired to do the self-sabotage. So I'm doing some kind of a self-sabotage. So if you don't do the daily debriefing, you are self-sabotaging yourself and your portfolio. So then, so that was the belief. So if you believe in it, then when you're doing the daily debriefing, then you need to be honest and thorough, because you're fooling yourself. If you're only fooling yourself, if you're not doing the daily debriefing. So traders fool themselves by not uh, learning these things. What I'm teaching right now, traders fool themselves. They're just looking for some indicator, so they're all fooling themselves. They're looking for, oh, he's not teaching about the indicator. Oh no, this is all mumbo jumbo. I'm out of here. I bail out. So don't bail out. Listen to what is being taught. Being honest and thorough, being appreciative of the process you're going through. So when you're doing the daily debriefing, you need to be appreciative of the process. So anything we're doing is just like, going to gym and lifting weight or doing the swimming is, it takes time to go and then do all the stuff, but we have to be appreciative that we are doing the right thing. So daily debriefing is performing. Also, the daily debriefing is same as performing mental rehearsal. So mental rehearsal is opening the loop. So in the morning, when we are getting ready for the market, we are doing the mental rehearsal. We need to do the mental rehearsal to be ready for the market. So we open the loop. And when we do the daily debriefing, we close the loop. So open the loop and close the loop. And ask yourself, what kind of a person are you? Are you the kind of person who open the loop and close the loop, or you just leave the loop open and leave it for surprise? So think about that. Now, the strategy for daily debriefing is ask. So this is the question you need to ask, that did I make any mistake today? Because you're doing the review, you go through the all the trades, you open, you close, and if you did not make any mistake, then pat yourself at the back. You say, okay, I did good. And if yes, then go through that process, which I explained, that I reach a choice point, and I had this choice, but I made this choice, and I should not have taken that choice. It was obvious. So next time I will not do that mistake, and mental go through the mental rehearsal of not doing the mistake. Now, I will explain to you about the mistakes in detail. So the mistakes in detail, the nature and causes of trading mistakes. So so you can write your own reasons for committing the mistakes. So here are some. So nature and causes of trading mistake. And then we will go through more into the cause and effect relationship. So execution mistakes. So we know we made some execution mistake. Instead of buying one, we bought 10. Instead of putting a limit order, we put the market order, etc. We didn't shave the spread, we just jumped in. So etc. These are all the execution mistakes. Maybe we did not deploy the proper strategy, so there could be a strategy mistake. Maybe we were not mentally fit to trade that day, so it's a psychological mistake. So it could be a psychological mistake. We were not ready to trade that day. We didn't have good sleep, we were stressed out, some event was occurring in the family, etc. So the brain is paralyzed. We knew the brain is paralyzed because of all the things, the stress, but we trade it. So it's a psychological mistake. Another reason could be the position sizing mistake. So you knew you were supposed to buy only 4 contracts, but you went ahead and bought 15 because that was a sure shot trade. And that sure shot trade turned out to be the loser trade. And when the loser trade, if you had to stick with your normal risk, you would not have been worried. But because you took the big risk, so even though the trade is moving in its own, is doing its own thing, but because you're committed so much that you are feeling the stress. Journaling mistakes. So you're not doing any journaling. So you don't bother doing your journaling. So it's a time wasting activity. So that's a mistake. You did not follow your trading rules, such as the stock was facing resistance and you went ahead. There was a news coming out, you did not wait. There was a certain time of the day you're not supposed to open the trade, but you went ahead, and so these are the mistakes. Lack of knowledge and education. You don't spend time in improving your skill and knowledge about the market. That's a mistake. Emotional influence. So you were in, greed, fear, and all those emotions which come into trading. You were one of those was playing role. You were overconfident in your ability because you had such a winning streak, and it has nothing to do with you, but you are overconfident that you cannot do anything wrong because you have a 10 winner trade. So you went overconfident in that trade because you said this is a sure shot and I'm gonna kill it, and you got killed. So overconfidence. Lack of discipline. You're sloppy. You woke up fresh. Last night you had a good time. This morning, yesterday you made a lot of money. So today, and then you had some other deals, and the money is piling up, and then you just sloppy. So when you sloppy, lack of discipline, didn't bother to look at the chart, just open your app, push some buttons, and executed the trade. So that's a mistake. Fear of missing out. You heard somewhere something, and the stock has already done its thing, it moved 10 points already, but because you love trading Tesla, it's already moved 10 points, so you say, okay, it moved 10 points, I rather not miss it. It's going to 280, I'm going to buy it 280. It's going, I heard somewhere it's going to 280, so I'd rather not miss it. Boom, you buy it. So that's a mistake. So all those are the nature and causes of mistake. Now you need to evaluate how you need to evaluate your trading mistake. So recognize your trading mistake. That's the first step. So recognize your trading mistake, do the daily debriefing, and then apply your knowledge and skill to evaluate all the mistake you did and how you would improve next time, tomorrow. So you're looking forward for the day that you will not make that mistake and not commit to that emotion, those emotions. So control the emotion. And Not only that, you have to understand the cause and effect of each mistake. So cause and effect. So what was the reason? So what was the reason for that mistake? So I will go into the detail. What is the cause and what was the effect? So why are you how you deal with the market, how you trade during the day, how you bring yourself to the market, all that, how you apply the trading knowledge, what else you do to trade. So all that, the understanding is the cause and effect of each mistake. So learn from your mistakes. Now, the bigger the cause, the bigger is the mistake. So if the cause is small, the bigger, smaller is the mistake. So if you instead of buying one contract, you bought two or maybe three, so that's a difference. But if instead of buying one, because the trading platform was set for 10 and you executed 10 contracts, that's a bigger mistake. So you will incur the bigger bigger loss. Instead of buying 100 shares because the trading platform somehow got set at 1,000 shares and you executed buy order for 1,000 shares, even though I have done these mistakes, so I'm giving you my own examples. Instead of buying 100 shares, I pushed the button for 1,000 shares, even though I got the warning that, hey, you are exceeding your dollar amount. Are you sure? I said, yes, I'm sure. And I pushed the button, and then I realized that, oh, I bought 1,000 shares because I see the red, or I see a bigger green. So why I'm seeing this bigger green, or why I'm seeing this bigger red. So I realized, oh, instead of 100 shares, I ended up buying 1,000. And I did see the warning. I did receive the warning, but I over write that warning. So financial losses piled up, and the psychological impact on me coming, and the reputation and confidence and the long term. So these little mistakes building up and causing my long term performance to degrade. So these small mistakes build up, and when the Christmas comes, I have nothing to show. So the long-term performance is getting affected. And then I am the easy prey for professionals. So those who want to sell to me at the higher price, etc., all that, I'm getting caught into all these emotions and greed and fear, etc. I'm selling at the bottom, I'm buying at the top, I'm buying 1,000 instead of buying 100, instead of buying calls, I'm buying puts. All that is just ruining my account. So now, so we need to calm down. We need to do the daily debriefing. We need to do the pre-trade analysis. So these are the steps we can mitigate our trading mistakes. So we do the trade analysis. So every trade should go through the same, like it's like a McDonald's. So think about it. Your trading is just like McDonald's. So you have a everything start, let's say, from 5 minutes. So you open your computer, you're looking at your trade, you have done your prepared your baskets, you know the market situation. Today is the oil stock crashing down, I need to buy some puts. So which stocks looking good for puts? Today is the biotech stock, they are crashing, I need to look at the biotech stock. Today the the technology stocks are moving up, so I need to pay attention to the technology stock. So all that I've done I'm doing the analysis and I'm documenting it. Detailed trading journey. I'm documenting my interval. At what interval I see what I expect to see and what I'm seeing. I'm laser focused on only looking for that, what I expect to see, I want to see, and I'm seeing it on a different time interval, and I'm taking action. So I'm recording everything. And what is going on, in what thoughts are coming in my head. So maybe during the day there's several thoughts are coming in my head for just one trade, what kind of emotions I'm going through. So I'm documenting everything, I'm reflecting on my mistakes, I'm trying to identify the improvements. So I'm documenting things, what area I need to work on for this evening after the market is closed, and what I will do tomorrow. So I'm tracking my progress, I'm staying consistent, I'm learning and adapting. I know what one mistake caused. So if you can quantify the mistake, so whatever is quantified you can and measured, you can improve. So try to understand what is the effect, the financial effect of one mistake, and the psychological effect of one mistake. So if you have a mistake journal, You can write down your mistake, your type of mistake, the financial effect of mistake, the psychological effect of mistake, what steps you took to mitigate that mistake in the future, and specific self-sabotage habits to get rid of. So you must have some self-sabotage habits. So write down that one for that each mistake. So create a journal. Journal could be an Excel worksheet with these 6 columns. So Excel worksheet with these 6 columns. The seventh one is maybe the symbol. So the symbol is missing. So put the symbol, the date of mistake, what was the symbol, what kind of mistake you did, the financial effect, psychological effect, then what, little notes for you to write, what you will do to eliminate that mistake, and what kind of self-sabotage habits you are having, you need to get rid of. So this mistake journal becomes a part of a daily debriefing. When you have a 250 daily debriefing structured document, then you have something to do the annual review. So you can do the annual review. Now I'll explain to you, instead of doing all that, what we do is something written here. So this is a self-deceptions. So these self-deceptions, these are the real life interview by the police officer, or the comment when the police officer stopped at the accident, or whatever the guy or girl was doing the stupid thing when they were driving and ran into the accident. And when the police officer is asking them for the like an interview, sir, what happened? So these are the real life quotes people have given. When the police officer asks you, Mr. Khan, what was the reason you were speeding? So, oh my goodness, what's the reason? So now I can come up with the real stupid reason, or I can tell the truth that there is no reason. Give me the ticket. So this is a self-deception. I collided with a stationary truck coming the other way, or an invisible car came out of nowhere, struck my car and vanished. So these are the real life self-deception. The same way we are deceiving ourselves in trading by not doing, taking care of our mistakes. So it's the same way, self-deception. So every time we commit a mistake, so if you're doing a daily debriefing. So just like a swear jar we have, if you're doing the daily debriefing and if you realize that you made a mistake, so just like a swear jar, you put some money in the kid. I have not seen the swear jar, but I've got this. I heard about it and I've seen the picture from the internet, so I put it here. So every time the kid curse or do something, they have to put the money here. So penny, quarter, whatever. So I think that's the concept. So if you make a mistake, you have a jar, swear jar or mistake jar, and you put it there. And if you're self-deceiving yourself, then you even put a bigger dollar amount in the jar and see how that jar gets filled. So that's the concept of sweat jar. Now there's something else I explained to you about the Ulysses. So Ulysses contract. So Ulysses was a hero who traveled and with his sailors and went on a journey to collect the whatever the bounty or the treasures. So there was an island where when the sailors passed through on the boat, there were some beautiful girls singing, and they want to entice these sailors to the island, and then they get killed. These sailors get killed. So Ulysses knew about this phenomena, about the sirens. So the trick was to put the wax in the ear. So Ulysses told his sailors to put the wax in your ears so you don't hear the sirens. And when you don't hear the sirens, then you will not go to that island, and then we will go home safely. Long term, they were away from their home for several years. Now they need to go home, and he himself asked. He asked his sailors to tie him onto the mast, and so that and told them that no matter what I tell you, you don't let me go. You don't. And then he did not put the wax in his ear. So he was hearing the sirens. His sailors were not hearing, but he was tied up in the mast. So the idea is, so this is called Ulysses contract. So the idea is, and the Ulysses was very known for his cunning intelligence. So he was a very intelligent man, and he made all his men safely to his back home. So the idea is that same way when we are trading, we need to remind ourselves about the Ulysses contract, that we, based on our past experience, we are preventing the present us from committing the mistake in the future, or destroying ourselves. So the same, if we apply the Ulysses contract uh, principle. So emotional control. We are not going to that island. We know we get killed, but the siren was so good that the sailors go there and they get killed. Robust risk management, being disciplined, going home. Long-term perspective. Long-term perspective is that we went on a sailing for 5 years. Now we want to come back home, and we are being based on the past experience. He learning. He knows that he needs to put the wax. He needs to stay on the ship and go home. So avoiding over trading. So greed. So don't go to that island. And managing cognitive biases. So all the kinds of biases coming in the trading, we need to be aware of. So this is a big topic of cognitive biases. I'll explain to you some today. So now there's something called correlation and causation. So this is very important. Correlation and causation. So I will explain to you what is correlation, and then I will explain to you what is causation. And then I will explain to you what is the difference between correlation and causation. And then I will explain to you 6 different types of causation. So 6 different kinds of causation is: one is no causation, another one is a linear cause effect, another one is a complex cause effect, then there is a personal cause effect, then there is an external cause effect, and then there is a magical cause effect. All these are psychological things, and the traders are using one of these cause and effect. When they're trading, they're applying one of these principles of cause and effect, and don't even know that they are applying these cause and effect in their trading and ruining their uh, portfolio. So, so in order to understand what is this phenomena, it took me a while to understand. Lot of lot of reading notes and all that. So I prepared the slide finally. So I'll explain to you what is correlation. So what is correlation? So the first we need to understand the perceiving. So when I was trying to understand this, so I came up with the word perceiving. So English is not my first language, although I know. Uh, so I know English, I know Urdu, I know Hindi, I learned Bangla, I learned Sanskrit, I know Arabic, and of course I know English, and then a lot of computer languages. Now I'm learning these words, still learning these words. So perceiving. So when I came up with the learn this perceiving, so I said, what is perceiving? So first you need to understand the perceiving, then you need to understand the correlation, then you need to understand the definition of causation, and then you understand the cause and effect. So this is where we are going. So what is the definition of perceiving? So definition of perceiving is act of recognizing and understanding relationships or associations between data points, factors, or variables. So then it will look like, oh my God, this is very complicated. So of course, the trading is very complicated, so many variables, so many factors. So act of recognizing and understanding relationships or association between 2 data points, or between 3 data points, or between 2 variables, or 3 variables, or thousands of variables. So that is the definition of perceiving. So, and another definition of perceiving is becoming aware of something through one's senses or mental faculties. So our internal stimuli, such as feeling we get, or some kind of emotions we get, or taste or senses, and then external stimuli. External stimuli is what you see on the chart, visual, so what you see or what you hear. So external stimuli and internal stimuli. So that is the definition of perceiving. So now we understand the definition of perceiving, we need to understand something more. So this is through, I put these words, perceiving through internal and external stimuli. So hearing, seeing, smelling, tasting, thinking, touching. So all these stimuli, whether internal or external, you are using it in your trading also. So think about it. You're hearing something, you're seeing something, maybe you get some good smell, I don't know. Maybe you're tasting, thinking, touching. So all these are playing role, these stimuli, internal or external, are playing role in our trading. So think about that. Keep this in mind, that when you're trading, are you using these stimuli? And there is something called neuro-linguistic programming. So NLP, neuro-linguistic programming. So through neuro-linguistic programming, if you go into that topic, which is I'm trying to understand, we come to know that we make the decisions based on some steps. Did we hear first, or did we see first? Did we feel first? So how you make the decision? So that is another different topic I'm trying to learn. So hearing, seeing, smelling, tasting, thinking, and touching. So these are the internal and external stimuli. So now senses and mental faculties. So through senses and mental faculties, we have the ability to detect, ability to comprehend, ability to interpret information and stimuli, whether it's external or internal thoughts and feelings. So that's the definition of senses, mental faculties. So ability to detect, comprehend, and interpret the information which is given to us while we are trading. So imagine all the information coming to you during the trading hours related to one symbol or related to the whole market. So think about that. So what is perceiving correlation? So we understood what is perceiving. Now we are trying to understand what is correlation. So what happened is traders, instead of, they get confused between the correlation and causation. So they apply the correlation instead of causation, or instead of applying causation, they apply the correlation. And then they have a different thinking. Instead of complex cause and effect, they apply linear cause effect, or they believe in the magical cause and effect. So all that I will explain to you. So traders confuse the factors that cause things with correlations. So there is a difference between correlation. So what is the correlation? So correlation is a statistical measure that describes the degree to which two variables move in relation to each other. So for example, if crude oil is going up, uh, so if crude oil is going up, then you say, okay, if crude oil is going up, let me see the crude oil stocks. So you look at Exxon and Chevron and all that. So you make that correlation. Okay, crude oil is going down or going up because of that. These oil stocks are going up or down. So you establish that kind of a relationship. So correlation quantifies the strength and direction of the relationship between variables. So if the interest rate is going up, the market must come down. So you created a correlation. Interest going up, market going down. So, or interest rate going up, market is going up. So there could be a positive correlation, so positive or negative. So that is a correlation. So traders should leverage correlations for effective trading. So now once we establish that there is a correlation with either a positive correlation or a negative correlation, so once we identify, then we should be able to leverage it. So if we believe that the crude oil is going down, there's not much demand, so the crude oil stocks are coming down. So we just open our workspace related to the crude stocks. So already build the like 20 symbols already there. Crude going down, okay, I need to check the crude stocks. Crude stocks, then you sort it, and then you select one or two. So that is a correlation. The crude going down, I go buy the puts on a crude stock. So that's the perceiving the correlation. Now, perceiving causation. So there is a difference between correlation and causation. Causation refers to the idea that one variable directly influences or causes changes in another variable. So there is a cause and effect. So I think like this: crude going down, okay, the crude stocks are going down. So that is also a causation. So causation implies cause and effect relationship. Traders should avoid making unfounded assumptions about causation. So this is, if the crude oil stocks are going down, and I assume that the crude in general is going down, I may be founding not the right assumption. I'm creating the cause. The effect is that the crude stocks are going down, and the only reason could be that the crude is going down. So have you seen the crude goes down and the crude stock goes up? So what happened then? There are some other factors. So we cannot confuse the between the correlation and the cause. So once we understand there's a correlation, and there's another thing called causation. So the example I read is that when the children, when they are in their teenage, they gain weight. So when they are growing, so they gain weight and they are increasing their intelligence. So we cannot say then, because my son grew up and he gained some weight and that's why he became intelligent. So that's not the reason that he became intelligent, because he gained weight. So that's not the reason. So think about that: correlation and causation. So the difference between correlation versus causation. Once we understand the difference between correlation and causation, then we understand what kind of a cause traders uh, put on for their trading success or failure. So that's what I'm trying to explain to you. And once we understand that what kind of a thinking we do as a trader, when we apply different kind of causes, then if we are aware of, we will improve our trading. So perceiving correlation means recognizing a statistical relationship between variables without making assumptions about causation. So that is the correlation. Correlation acknowledges two variables may move together, but it does not imply that one causes other. So if Chevron is moving to the downside and Exxon is also moving downside, it doesn't mean that the Chevron and Exxon are related together. It could be that something else is happening out there. Causation asserts that one variable is responsible for changes in another. So if the crude is going down and the Chevron is going down, maybe that could be directly affected. The crude is going down and the Chevron stock is going up, or maybe there's a buildup of supply, so that's the reason the crude stock going down. So that the reason was there was a lot of buildup supply, so not much. So there's over inventory. So, so now, which one is important? The causation is more significant. Causation requires robust evidence. So for every cause and effect, there's so many variables in the market. The market is moving, and sometimes we wonder why the hell the market is going up. When the interest rate increase, the market is still go up. Or when the inflation rate is something else, the news comes related to inflation, the market is still go up. Whereas we were expecting the other way. So why these kind of phenomena happens? So perceiving correlation in trading. So I'll explain to you correlation between different assets or economic variables. If two assets have high positive correlation, their prices tend to move in the same direction. So if gold, let's say the gold and the crude have a positive correlation. If the crude goes up, gold goes up. So that's a positive correlation. If the crude goes down, the gold goes down. That's a positive correlation. Or if they move the other way around, that's a negative correlation. So oil stock move upward or downward based on crude oil demand and supply. So that is a positive correlation. The oil stock go up when the demand go up. Oil stock go down when the supply goes down. Supply go up. So this is a positive correlation. Holding several oil stocks may not serve diversification. So if you are applying the correlation and all the oil stocks go up when the demand go up, then you are not applying the diversification in your portfolio, because you know the home builders, the home supply is less, therefore the home builders stocks are going up, and then you piled up on KBH, Lennar, and all the home builder stocks. So you are not applying the diversification. You're just applying the correlation, and you're building your portfolio, not doing the real trading. So perceiving causation in trading. So what is perceiving causation trading? Oil stock moving upward does not mean demand for crude is rising. So the cause in the oil stock moving upward may not be, the reason is not that because the demand for crude oil is rising. There could be some other factors uh, playing role. Maybe there is a bomb drop somewhere, some refinery is out. That could be the reason or something. So the market knows a lot more than what we uh, try to come up with the reason, saying, oh, the oil stock moving up because of this. No, there could be thousands of variables which we don't know, and the market knows. So the market knows, we don't know. So how to trade successfully? You trade successfully what you see in front of you, what is happening, not come up with your own judgment. There could be other factors in play. So making trading decision based on assumed causation. So assume causation because the oil stock is going up because some crude oil must be going up. No. So assume causation without robust evidence. So we need some robust evidence can lead to poor decision making. So making trading decision based on assumed causation, just assume something without robust evidence can lead to poor decision making. So this is perceiving causation in trading. So we understood what is perceiving, we understood what is correlation, then we understood causation, and then we understood perceiving correlation in trading and perceiving causation in trading. Now, so avoiding pitfalls of correlation and causation. So understand the correlation. So in the market, we need to understand the correlation. If interest rate going up, then what happens? If interest rate going down, then what happens? If inflation is rising, then what will happen, etc. So avoid assumption of causation, conduct thorough research, and implement the robust risk management. And there are some notes here: investigate historical data, market context, and all the relevant information, and then make your decision. So now there are traders, or there are human beings which believe in no causation. So they are not aware that there are some cause and effect happening. So when they are not aware of no cause, there's no cause, then they operate in a different way in their life and also in trading. So I'm trying to explain to you through these slides. When a trader comes to the market and does not believe in any causation, this is the way he trades. So he live in a world that does not make sense. He's a lack of causal connection. He doesn't understand there is a cause and effect relationship. So he sees something, let's say Tesla going up, and he doesn't know. There could be hundreds of variables why Tesla is going up. And since he's not aware of, he does not even think of cause and effect. He sees the Tesla is going up, he just buy the Tesla. Or if Tesla is going down and he has a position, he just sells the Tesla without understanding without going through and evaluating the reason for Tesla going down or Tesla going up. So understanding that, he may make the proper decision in trading. So lack of causal connection, not recognizing cause and effect relationship. Things just happen. No intelligence drive the world. Limited awareness. No explanation regarding how processes work, how the market work. He's not aware of events occurring randomly by chance. The things are just happening here, there, and he's just isolated and just looking at the Tesla chart and saying, okay, Tesla going up, and then I just go buy it. Tesla going down, oh, I need to sell it. And then next day Tesla go up again, and then he wonder what happened. So this is the kind of trading the person is doing who does not have a knowledge of cause and effect. So this kind of trader relies on unrelated and superstitious beliefs. So I will explain to you what kind of a superstitious beliefs the traders have and people have in their life. They do not rely on fundamental factors. This kind of trader do not rely on technical factors. There is no rational understanding of market dynamics, how the market works, have no clue. Important, it's in this kind of trader has to address such misconceptions, such as no knowledge of fundamental factors, no knowledge of technical factors, don't have any knowledge about the market dynamics. Rather, he's just out there trading on some superstitious belief. Now, the limited awareness. So if we explain the limited awareness, a limited understanding of the underlying mechanism. The market is very complicated. They are all interlinked. So doesn't understand the completely about the market, limited understanding of the factors that link events together. Something is happening somewhere. That's why this market is moving. Some sector is going up, some sector is going down. Overall, the market is bearish. So why, if the market is bearish, the biotechs going down, the oil stock going up, but then the Amazon is moving, or Nvidia is moving, or Spot is moving? Why they are moving? So lack of knowledge. Trader possess incomplete information. Traders operate under cognitive biases. So traders have a different kind of biases. So they want to see what they are seeing, what they want to see. They are believing what they want to believe. So that's what the mind is driving them. So that kind of mind they're driving. They want to see something, and they are seeing it, and they are trading that way. So what is happening? Multiple implications are happening. Implication for decision making and problem solving. So if person doesn't believe in any cause and effect, then he is making the wrong decision, and he cannot solve the problem because he don't understand the cause and effect. And also he is missing out the trading opportunities. So if the crude, let's say the crude is going up, and he is just looking at the stock, and looking at the basket of crude, and the crude stocks are not moving. So not moving, he's missing out the whole picture. Why the crude stock is not moving? Maybe there is another symbol which moves the other way. When the crude goes up, that goes down. When the crude goes down, that crude stock go up. So there must be some other reason. Inability to address issues, the root causes effectively, because he doesn't believe in causation. He doesn't apply the knowledge, so he's unable to address the root cause. And trader does not recognize the relationship between different factors or events. So his mind does not comprehend the different factors or events and how the market works. So this is the kind of trader. Most of that 70% of the traders, they are like that. So miss trading opportunities, no causation. So miss valuable trading strategies. So missing out all the strategies, trading, not applying the trading strategies, just not thinking enough. Execute trades without fully understanding the causal factors. Just execute the trade without understanding what is driving this sector down, or what is driving this sector up, why this sector is reversing to the upside, why now they are all going down, the market is going down, why it's not going down. Maybe this rally is temporary, is just temporary, and he is just holding it, or he's not building the position. Factor that drive price movement, he doesn't understand that. Traders fail to capitalize on trend and reversal. So the trend and reversal are building up, there's a change in the trend, and because he doesn't understand the cause, and he doesn't understand the cause, he doesn't believe in the causes, so he is not seeing the effect of the causes on those stocks. So understand the cause, understand the effect. So if no cause, no effect. So lack of strategy development, he doesn't have the any trading strategy because he doesn't believe in any cause. He's not even aware of the word or the phrase called cause and effect. So developing trading strategy based on lack of causation. His trading strategy is just to look at some chart, see something and just buy it, see something and just sell it. So failure to identify cause and effect relationship between market event, new releases, economic news releases, economic indicators. There's so many variables. So have to make some relationship. Then understand and trade. Failure to recognize can lead to inadequate risk management. So taking extra risk and significant losses. So if he is long or if he is short, and he sees the market is turning around, but because he cannot establish the cause and effect, so he's just holding that position, and that position keeps on moving to the upside, and he's holding the shorts. So hinder in development of profitable trade strategy development. He needs to understand the shift in the sentiment, and maybe these are the reasons, and this is the cause, and this is the effect. He needs to close his short and open the long position. So what is another no causation? The effect, risk management. So effective risk management depends on perceiving causation. So if we understand the cause for the market to rise, we'll be able to reduce our risk. Maybe we cut down, we say, okay, no, this is extra risk I'm taking. The market is moving against me because of this cause. So no causation, no risk management, inadequate risk management, significant trading losses. So this kind of trader is experiencing significant trading losses because he doesn't believe in cause and effect. He doesn't have any trading strategy. Cognitive biases. So this is a big topic. Cognitive biases. There's so many biases: availability bias and desirability bias and attribution biases. So all this kind of a biases, the trader is bringing it without understanding that there's a cause and effect. So he's over trading. He's making emotional decision making. He's acting impulsively. Attribution biases. When he make the money in the trade, he attributes to his skill. When he loses in that trade, then he attributes that to some kind of a luck, some superstitious beliefs, or some market maker, or somebody is out there to get him, or his luck. So all this is playing role without, because he doesn't believe in any causation. So attribution biases, over trading, emotional decision making, acting impulsively, all that is going on in the trader. So learning, he doesn't learn and adapt. So because he doesn't understand the cause and effect, so he doesn't even think that he needs to to spend some time. So perceiving causation critical for traders learning and adaptation. So perceiving causation meaning that there is a cause and effect. There has to be some cause and has an effect. So sometimes let's say you say, why that person was behaving like that, must be reason. So at that time it's not obvious, but 10 days ago you said something and that's why he's behaving like that. So, or your child, so that's a perceiving causation. So if you say, okay, that my child is just moody, no, something happened, so you better dig deep and find out. So perceiving causation critical for traders learning and adaptation. So you learn if you perceive the causation. Analyze past trades and performance. So go through the debriefing and analyze your past trade and performance and see what you saw and how you took the decision. Identifying what caused success or failure. Traders may struggle to learn from their experiences and improve their trading strategy. So if they don't believe in cause and effect, they are not learning anything new. They're just coming in the market, trading something, and going home. And there's no systematic trading also. So there's no systematic trading, there's no algorithmic trading, there's no rules, there's no checklist, because there's no cause, so there's no effect. So if there's no cause, there's no effect. So how there's no systematic trading, there's no rules, no checklist. So the systematic trading relies on a specific criteria, some kind of a cause, an indicator to trigger trades. So if you don't believe in some cause, then there is no system. When there is no system, there is no trade, there is no entry, and there is no exit. So you're missing out all the profitable trades, all the trend reversals, all the trend continuation, all the breakouts, all the gaps, etc. Everything is missing out because you don't understand the cause and effect. So in order to implement or design and implement the effective automated trading system, we need some kind of a cause and effect analysis. So if this happened, I would do this. So these are this is the criteria of system thinking. System thinking instead of just the love, the life is without causation. The last one, the market analysis. So so we need to understand the fundamentals and technical analysis. And that's why, due to this fundamental factor, this stock is moving up. Due to this technical analysis I did based on the previous chart patterns, and I've analyzed it, and because of I see this, the stock needs to do this and move this distance. So rely on causation. The market analysis rely on causation. You need to do some analysis based on fundamental and technical analysis that is driving the asset prices. So it could be economic data, it could be corporate earning, it could be geopolitical event, it could be historical price pattern. So historical price pattern, technical analysis, fundamental is economic, corporate, geopolitical. All these are driving the price up and down. So if we don't believe in it, we fail to do the market analysis properly. Now, if we don't believe in the cause, we don't evaluate the news and events. So we don't respond to the news and events. So responding to news and events if impacting market. If we don't believe in causation, we are not responding. Recognizing causal link between news and potential market events. So if FOMC is coming, if we believe that the FOMC is coming and this could happen, then there's a cause, and this could be the effect. So if we don't believe or not aware of FOMC or any other, then we will not be able to make the informed trading decision. So there's another problem with the trader. Another problem is the superstitious belief. So if the trader does not believe in causation, he believes in superstitious belief, wearing his like a lucky shirt or a hat, or if it's a Tuesday, it must be a good, or if it's a Friday, or if it's a Monday, or if it's an odd day, or the day start, the letter is number 8, all that kind of, they bring superstitious belief, or they sit on a chair the grandpa gave him, and so he's sitting on a lucky chair every time. Or the people, they kiss that, when they're throwing the ball, they kiss it, or they put the coin, they do all kind of a stupid thing, the lucky coin, etc. So all that is a superstitious belief. Or they go to the saint and get the blessing from the saint. The saint saying, if the saint says don't trade today, you're not going to trade today, because that today is the bad day for trading. So attributing outcome to superstitious belief approach lacks a logical foundation. There's no logical foundation, no direct, just random trading. So think about it: random trading, inconsistent result, failure to learn, and risk of losses. This kind of trader who doesn't believe in causation believe in superstition. So he's believing in superstition, and he is doing all this kind of trading. So think about that. Now, there's another kind of trader. This kind of trader is at a higher level. So he's higher level because at least he believes in the cause. So the previous trader doesn't believe in the cause. He's not aware of. But this trader, he perceives there is a linear cause and effect. So linear cause and effect is that he's at the other end of the continuum. So on one hand, if you draw a line, or like a horizontal line, if I draw a line here, and on one hand I put linear cause effect on the right hand side, on the left hand side I put a causation, no causation. So this guy doesn't believe in no cause, he's not even aware of. But this guy who is on the other side, he believes in cause and effect. Everything has a cause and effect. But he he's focusing on a linear cause effect, and the market or the world is more than linear. So it's complex. The market and the world is complex. It's not just linear, that one cause have this one effect. So he believe in the closed system world. So this trader, he believes in closed system world, just one reason, one outcome. Everything result from direct and immediate causation. If crude oil is going down, crude oil must go down. That's his linear cause and effect. So if the crude oil is going down and the crude oil stocks are going up, he failed to understand why it's happening. So everything, but he at least understands there is a cause and effect. The crude oil is going down, the stock, maybe crude oil stocks going down. So everything results from direct and immediate causation. The style, so the linear cause and effect, if we study where is applicable in mathematics. So 2 plus 2 is equal to 4. It cannot be 5. And in physics or in chemistry, so the linear cause effect. But the linear cause effect is not applicable in human sciences or politics or economics. So think about that: politics or economics or communication, and also in trading. So linear cause effect is not applicable for trading, but people trade based on linear cause effect. The thinking is very close, just one, like a blinder on the horse. So linear cause effect really exists in the complex world. So if the crude oil is going down, and all the crude oil stocks should go down, there's just one linear thinking. There's more to it than just establishing this relationship. So when a trader believes in a linear cause effect, he become overconfident. So he's trading overconfidently. He's betting, okay, I'm gonna buy all the puts in the crude stocks because the crude is going down. Something is happening, I'm just going to buy it. And sometimes he wins big, and sometimes he just, overdoing it. So ignoring the market complexity, failure to adapt, and loss aversion, he's not implementing the strategy to avoid the losses, and inaccurate predictions. Just because the crude is going down the crude stocks will go down, and he goes and finds something which is going down. It could be temporary, and he failed to read or understand the complex nature of the market, fail to understand the trend in that stock maybe is a trending, the strength is very strong on the upside, is just a temporary short um, pullback. So short pullback can be capitalized, but if he fails to understand that, then he is ruining his portfolio. So what should traders know and avoid? So embrace complexity. So trying to understand that the market is very complex. We need to, it's not just linear cause effect. Embrace complexity. We need to adopt and diversify the strategy, have a robust risk management, continuously learning, back testing, staying flexible. So staying flexible and psychological awareness, just not go all in just because one thing is moving the other way and the things are looking good. So be aware of that. Another one, there's another thing called complex cause effect. So this guy is above the linear guy. So there's a guy who doesn't believe in causation, and there's one person who believes in linear cause effect. And then there is a trader who is very sophisticated, and he believes in complex cause effect. So this is the kind of trader we need to be. So he knows that causal complexity, there are a lot of complex variables, there are a lot of factors driving the market. There's not a single direct cause for an effect. He's thinking above the linear level, and he's not a close system person. He's if the system is open, there are a lot of variables are affecting in the system, and he's a system thinking kind of person. So he's putting 2 plus 2 together. In all things are interconnecting. Maybe something is happening in Japan, and the effect is coming this afternoon in New York. So system thinking, multiple interconnected factors coming together. There are a lot of factors, they are coming together. Futile to think in terms of linear thinking, just because if interest rate going down, maybe the technology stocks will go up, something like that. Just linear thinking, something else is happening there. So how perceiving complex cause effect relates to trading. So now we need to think about that. Okay, the complex perceiving, how it affects to trading. So think about that. So I'm just giving you the point, and later you do the research. So market dynamics, understand the market dynamics, all the economic indicators, all the geopolitical events, all the market sentiment are affecting the market. So market is way complex, and we just oversimplify. Just look at the chart on a 15-minute, and this thing is moving, and then I just go and buy it. So I'm oversimplifying it because it's more than that. And if I don't apply the complex, then I'm not implementing the robust risk management. I'm not applying the technical analysis properly. I'm not understanding the fundamental analysis properly. I'm not understanding the diversification. I'm piling up on a home builder stock or a technology stock or just a crude stock. And if I don't believe in the complex cause effect relationship, then I'm not open to learning. I'm not even aware of. So if I'm not aware of, then I'm not open to learning anything. There's nothing to learn. So there's nothing to learn, and I'm not doing any back testing and analysis. I'm not flexible because I don't even know there's a complex cause and effect. So I'm not staying flexible, and I'm not psychologically prepared. So the person who understands the market is complex and a lot of factors are driving the market. He is psychologically prepared. He is flexible. He is continuously learning. He understands the fundamental factors. He understands the technical analysis. He understands the risk management. He's not oversimplifying that, okay, I just open my Robinhood account and I buy Tesla weekly options, not even monthly, just weekly. And the weekly just buy on Tuesday and hope by Friday I double my trade. And if not, then it's okay. I will top it again. $2,000. I'll get some $2,000 from somewhere next week and I will top it $2,000. So now I give you some, two examples. One is about the Tesla and one about the Meta. And I'll give you some examples in other scenarios. So think about this perceiving complex cause effect example on Tesla. So think about this: the Tesla is running, and a trader named John actively monitoring Tesla. So he loves trading Tesla, and he suddenly see the increase in Tesla price, 10% is spike in price. Earning, he checked the earning report. It says beat market expectation. He checked the market sentiment. This in the morning, the market was all bullish. Everything is lined up. All ducks are in the row. So broader market trend bullish. So this is another, another checklist. Tick, tick, tick. Okay, Tesla running 10% spike, earning beat, market is bullish. Then he read the industry news. He says, "Oh, competitor of Tesla facing regulatory challenges, benefiting Tesla." Oh, it's even good. So competitor of Tesla facing challenges, which is benefit for Tesla. Another reason. So he checked that. Then he read a news on that analysts upgraded Tesla. So major firm upgraded Tesla. That's another one news. So that's positive. Then he look at analyze the volume. So he knows how to analyze the volume. And he look at the volume, absolute volume going up, the relative volume up, the bars are moving up. So he not only did the price analysis, not only he did the market sentiment and the news and everything, and he did the volume analysis, and he applied and he bought the Tesla. So he evaluated all the complex cause and effect, and the Tesla trade turns out to be the winner trade. Now, same John, he also trades Meta. So think about same John, he trades Meta also. So there's war in the Middle East. Okay, somebody dropped some rockets, and someone is throwing the bomb. So and he's watching the news on the Fox channel, and he says, "Okay, war in Middle East broke out. Future market down. Okay, price direction in the market. In the morning, he wakes up and he's ready. He said, okay, the market is going down. So I look for something which is gapping down. So broader market is bearish. Bombs are flying everywhere. Market gap down, and then because he believes in a complex cause and effect, so he did the industry news. He read the industry news. Industry news says competitor Meta facing regulatory challenges, but also affecting Meta. So in the Tesla case, the competitor was facing challenges and it was favorable for Tesla. But in the Meta case, is also the competitor is facing the challenges, but it's also affecting Meta. So he failed to analyze this part that is also not favorable. Analysts downgrade. So he did that, and analysts also downgraded the major firm downgraded Meta. So he said, okay, this one is also good. Trading volume is open significantly higher than average volume. So this just like Tesla, everything is like Tesla going up, Meta going down. So when the market opened, he bought the puts on Tesla or Meta, and or he shorted the Meta. But what happened? The Meta went down a little bit, and then it suddenly started to rise, and then it started to go up and up and up and up. But John is you know thought in his complex cause and effect, although he did everything correctly, but he failed to understand that the Meta is not doing what he is perceiving this complex cause and effect, and he needs to close the Meta short and go on the other side. So he fails, and then he loses on the Meta. So that is a complex cause and effect. Now there is something called personal cause and effect. So personal cause and effect is the personal role we play in causing, affecting, and influencing things. So we personally playing role in affecting and causing the things in our life and also in trading. So self-serving biases, we bring self-serving biases. I'll explain to you. Attributing positive outcomes to own actions, abilities, and skills. So personal cause and effect. When we are successful in trading or in a particular trade, so I give you example. So in Tesla, John attributes his success not on only his ability to analyze the market and Tesla on a complex cause and effect basis, but also he's attributing his success on Tesla on his ability and skills, his own actions. Whereas the same market, complex cause and effect, and the Meta where he did everything right, but the Meta did the other way around. So now He is attributing the outcome, the losses in Meta, to some external factors or some kind of a luck or some kind of a tweet or some kind of a that guy should not have talked all about this, that one. No. He just goes on some other factors and not realizing that the Meta has turned around and he did everything correctly. But now the last thing he need to do is to close the Meta trade and understand that this trade is not working in his favor. So he's bringing his personal cause and effect. He believes in his own ability that the market will turn in his favor, and the losses are due to external factors and his luck. So how to avoid personal cause effect? First of all, avoid being overconfident. Overconfidence. So avoid being overconfident. Avoid attribution biases, which means that when the trade is a winner trade, you assign it to your skill. When the trade is a loser trade, then you assign it to your luck. So avoid doing that. Implement robust risk management, meaning you saw the breakout into the downside in Meta. So the breakout occurred from some level. So there has to be some level where the chart should tell you that this breakout to the downside is a failure, and you need to close that trade. So did not do that. Avoid biased decision making, because we bring our personal cause and effect. So we bring our biases. We need to learn from our mistakes. We need to maintain our trading journal. We need to seek external input, meaning, pick up the phone, call your trading buddy, reach out to your mentor, read some books, or go on some Facebook group where you think people are there to help you, some communities. So seek some external input. Stay humble. So stay humble. Just because you made a lot of money in Tesla, you were successful, now you're doing you're going sloppy on Meta because you did the same kind of analysis, and now you're not staying humble, you're going arrogant and cocky, and that's where the market comes and get you. So learn continuously, embrace losses. So cut down your loss. You did everything correctly under the complex cause and effect, but you're not cutting your losses on Meta, and you're not doing what is called embracing losses. Be healthy, responsible. So this topic is big, and I'm learning. I'll explain to you what is healthy, responsible. So some people are over responsible, some people are under responsible, some people are healthy responsible. So be healthy responsible. It's your own portfolio, is your own account. So be accountable for your portfolio and close the Meta trade. So I give you another example of John. So John is an experienced trader. He consistently profitable in the stock market. So he's consistently profitable. He attributes his success to his exceptional analytical skills, the ability to pick winning stocks. So a string of winner trades, one after the other, on the long side, on the short side. So then based on all that, and he did his complex cause and effect, and he took a significant long position in Apple. So now he turned into Apple. So he traded Tesla, he traded Meta, now he's trading Apple. So he believed sure bet based on his analysis. So it's a sure bet. So sure bet meaning 100% winning chances. I go all in. What happened? Unexpected global economic crisis hit. Somewhere somebody dropped the bomb, and the news comes out, let's say on Saturday morning, and he opened the position on Friday, Saturday morning, and he cannot do anything. Now comes Monday. So stock prices plummet across the board. So the future market open and everything is going down. And his market, the New York Times, his Apple position is start to incur substantial losses. Apple is just crashing. So now what happened? Because of his personal cause effect bias, he attributes his losses to a temporary setback. So this temporary setback. John remained convinced of his trading prowess. He believes in his skill. John believes his analytical skill will eventually lead to a rebound in Apple. So he believes because of his analytical skills, Apple will rebound. So he's going that way. Because of his analytical skill, Apple will rebound. John believes he will recoup his losses. So this is what he is doing, the personal cause and effect. So what is the mistake? John decided not to set a stop loss order. So he canceled the stop loss order. John decided not to take any risk mitigation measures, so maybe he could have sold some, did some covered calls, etc. He didn't do that. John continues to hold on to his losing position in Apple. John hopes market will turn in his favor. John hopes that this Middle East war is just a temporary, some rocket fired, and they will calm down and everything will be all good, and Apple will rise to the upside. But what happened? Consequences. Apple price continues to decline. So Apple was not just going down because of somewhere the bombs are dropped, but there was something bigger than that. Somewhere which we will find out maybe 2 weeks from now, that this thing happened, and it's happened because something happened in Taiwan, or something happened in India, or something happened in China. Because of that reason, Apple was going down, not because the bomb dropped somewhere. So John lost his mount. John portfolio suffers significant damage due to his inability to acknowledge the broader market condition. John has a stubborn belief in his analytical ability. So he is attributing his trade on success, coming success, on his ability to analyze the chart of Apple. So his cognitive biases leads to inadequate risk management, failure to adapt to changing market conditions. He doesn't understand what is happening, objectively assess the situation. His failure to objectively assess, he's attributing his losses solely to temporary setback, some Middle East war. So John failed to make rational decision. He's seeing the Apple is crashing, but he's not closing the trade because Apple will rebound. So that is a personal cause effect. Now there's something called external cause effect. So I'll explain to you the external cause effect. So external cause effect is we say we ourselves, because we are not responsible. We blame others. Human have a tendency to blame others. Human have a even when I showed you the self-deception reason. So think about all those self-deception reasons when people gave to the police officer when they ran into some accident. So we play no role in causing, affecting, influencing things. External locus of control. So the locus of control is outside of us, beyond our control. It's not within us. So we attribute all the outcomes or events or situation beyond our control, and we empower circumstances, events, and environment. We blame others, accuse others, and it's what could I do? I just happen to be there, and the world is rigged, and they are out there to get me, etc. The market makers and the institution buyers, the high frequency traders, and all that, and my broker, and all people are just against me. So fail to acknowledge the role of our own actions or decisions. So the traders are doing that who believe in external cause effect. So external cause effect, blaming external factors, lack of accountability, don't look inside, inconsistent trading, because believe in external factors. So there's inconsistent trading, there's a poor decision making, and significant trading mistakes. All the bad thing which traders are so not supposed to do, they are doing it because they believe in the external cause and effect. They are not aware of self-aware, what is going on within them. They are not accountable of their action. There is no consistency in trading. There is no robust risk management. There is no desire to learn anything. There is no desire to evaluate the emotions. So there is no such thing in their life because they believe in external cause effect. So I'll give you example. John actively trading stock for several months. So he's trading Tesla, he's trading Meta, he's trading Apple, he's trading Nvidia, he's trading AMD and all that with some mixed results. So some profitable trade and some loser trades. So it's fine. So now he incurs some losses. So because he believes in external factor, for what he's doing, he believes in market manipulation. He believes in some economic events happening. So he blames some economic event, some if he's a Republican, he's blaming Democrat. If he's Democrat, he's blaming a Republican. And why this guy is visiting China? He shouldn't be in China. Why he's there? Why he's in Israel? And this and that, all that kind of a thing. Why they're raising the interest? Why? All that. And financial media. So he's on the Fox News. He's reading this, and then he goes on CNBC. He read that, and then he blames one or the other. And then he blamed other traders like market makers and big boys and institutional traders and all that. They are out there to get him. and he gets frustrated and disheartened. So he's blaming in all the external factors beyond his control. Instead of what he's supposed to do, he needs to reflect on himself. He need to improve. He need to implement robust risk management. He need to take care of his emotions and see what is happening in his life, some kind of a balanced perspective. So the balanced perspective is the market is beyond control of one person. So there are a lot of complex cause and effect. So he needs to understand that. So he's not doing it. Now there's another kind of trader who believes in magical cause and effect. So we talked about the trader who believes in only in correlation. Then we talked about causation. Then there is a trader who doesn't have a clue about the cause, so no causation. Then there is a trader who believes in linear cause effect. So he just believes in the closed system, just one and one. This makes the stock go up. So he believes in linear cause effect. Then there is a trader who is a good trader who believes in complex cause effect. So he's doing his right thing. Then there is a trader who believes in personal cause effect. Then there is a trader who believes in external cause effect. Then there is a last trader who believes in magical cause effect. So this magical cause effect guy is like a child. So the children believes in like my daughter, the last year, she was saying, "Daddy, do you know all these heroes we come to know in the Disney? They are all fake. They are not real. Really? Yes. And even Santa Claus is fake. Baby brother believe in Santa Claus. There's no Santa Claus. It's all fake." So at least the child, after reaching certain age, they know that this is all made up. But the adult, they still living in the magical thinking stage. So they live in a magical world, hoping and wishing that our wishes will come true. So even athletes, so basketball players, baseball players, or they do some kind of ritual. So that is a superstitious way of thinking. Same way, so like a primitive culture. So same way, traders also do that. They adjust. So there are newsletters based on the stars, constellations, angels and demons and saints. So the traders, they approach all these people. They believe in the okay angels. I believe in angels. I do believe there is a Saturn, but I wouldn't be trying to consult with angels or demons and saints, or believing in the stars and constellation that the will work. Sometimes it will work. Some believing in the stars and constellation, when it work, I will beat my chest. That look at the Jupiter is aligned to Saturn, and this thing happened. So and then 99% of the time doesn't happen. So I just stay quiet. And if my saint tell me not to trade on Thursday, I wouldn't trade on Thursday. Or between 10 and 11, you should not be trading. You should just kneel down and don't even touch your mouse. So my saint is telling me, so I shouldn't be trading between 10 and 11 a.m. So ritual repetition of various secret knowledge hold the key to success. So the people who believe in magical cause effect, the traders who they are doing also the same. So magical cause effect, cognitive biases, seeing what we are wanting to see, and what we are seeing and not happening, we are just ignoring it, closing the box, attributing outcome to mysterious or supernatural forces, and instead of focusing on logical or observable causes. So instead of thinking logically, the complex cause and effect, not just believing in these superstitious things. So irrational. When there is a if I believe in this, if I believe in this, the stars and constellation. So think about that. If I believe the stars and constellations aligned, or they are against, so the conjunction and all that. So if you believe in that, so you just if it says on midnight, if when the Jupiter will be aligned with the Saturn, and then you need to go and buy crude contracts, and you go and buy the crude contracts at 12:01 a.m. Pacific time, and then you wait, and then crude is going down. So what are you going to do? Where is your exit for stop loss? Yeah. So And then, I mean, would you consult the stars and constellations and call the guru that, hey, guru, you said Saturn will align with Jupiter, or this, and I bought 100 contract of crude, and the crude is going against me. What should I do? So the guru don't have any idea. He will just say, just put some stop loss and get out, and then you get out, and then wait for the next alignment with the moon rising, full moon above the New York Stock Exchange, and then you go and buy the crude stocks. So this kind of thinking, and then there is no exit. And where would you take profit? So all that kind of a trading is happening. So superstitious beliefs, specific rituals or lucky charms, astrology, believe in astrology and numerology and planetary position and specific numbers like 8. So one time I went to Thailand, Bangkok, and there's a big place where there's no like that place was full of Chinese, the full of Chinese, all hotels Chinese, all Chinese restaurants. So I came, so when I dig deep, and then there are people selling lottery numbers, some lucky numbers, and then there next to it is a massage parlor, and then the Chinese restaurant. So that is a big market based on all that. So they come, and then you buy big thing to spend money on lottery. You go and stay in this hotel, you spend money on this massage parlor, then you go and eat in a Chinese restaurant. So all that, and they are buying the numbers. The telephone number is starting with 8, and the feng shui and all that. They just come there before they start anything. They consult. There's a somewhere there's a fortune teller sitting. There's a card reader sitting. All that kind of things are happening, and then you go there, and whatever they say, you follow. So think about that. Conspiracy theory, these kind of traders, they believe in secret organization, extraterrestrial forces, government manipulation, primary driver of market movement. So if the trader is believing like that, he is just ruining his account. So avoid the costly mistakes and magical cause effect. Believe that the market is so complex that it's very hard to trade the way the retail traders are thinking. No cause effect or linear cause effect or magical cause effect or personal cause effect. So rational analysis, proper educate, discipline, psychological awareness, robust risk management, and objective evaluation of each um, trade. So think about John again. So the last example of John is that John believes in astrology. So he believes in astrology. He subscribes to some online service, and that guru sent him some stock prediction that the crude will go up tomorrow because uh, Jupiter is aligned to Saturn or something happened. At 12:01 a.m., John should wake up, set up his clock, alarm clock, wakes up and buy some crude contract. So he goes and buy, even though the crude is going down, John is buying crude contract going long. So he received alignment of stars and planet. Maybe the stock prediction is to buy Apple. So today is a lucky day to buy Apple. Jupiter and Mars are in alignment. So positive market influence, because Jupiter and Mars in alignment, and based on this study, whenever the Jupiter and Mars are in alignment, Apple goes up. So go ahead and buy Apple. So John believes in it. John puts his bet, buy significant shares in Apple based on some astrological prediction without conducting any fundamental or technical analysis of stock. Cosmic alignment will ensure a profitable trade because Mars is aligned with Jupiter, so Apple must go up. But what happened? As soon as John bought Apple that day, the Apple went up, and so he's happy that this thing is working out. And next day, this Apple starts going down. There's a earning came up. The person based on astrology, he also mentioned that the earning, because earning is also coming up. It's right on the Jupiter aligned with Mars, and earning date is set. The stock will go up. And then when poor quality earning came, negative news comes. Apple enters bearish trend. John incurs significant losses. So this is what happened to the magical cause effect. So what John does, John attributed trading decision to astrological prediction. And astrological prediction is what? Magical cause effect. There is no objective analysis, ignored all the fundamental factors, did not study the financial health, did not study the market condition, did not study news, and experienced significant losses. And he ignored the rational data driven approach to trading. So, all that, what we understood, that the traders fail to um, understand the cause and effect. So it comes with the experience. And this is a quote I got: the experience is not what happens to a man, it is what a man does with what happens to him. Aldous Huxley. And all that will come to us if we are willing to go beyond our comfort zone. So I conclude this session now, and I will see you in few days with another topic. All right. So thank you for coming. I'll see you in a few days. Thank you. Bye.